also from an inflationary perspective, and I think it's very important to be minded of this, potentially you have a significant increase in workforce if you've got people moving from the public to the private sector, which then takes a lot of the heat out of wage pressure, which is a disinflationary issue in the first instance. So you've got more supply coming in to the job market. On the back of that, also the overarching impact of potentially lower energy prices. Energy prices are global, so it's going to be a very hard job for the US to be able to assuage global oil prices and energy prices across the board, but they do have the ability to do that by becoming a significantly bigger exporter of energy, which is what the intention certainly is there. Hey guys, welcome to this week's Money Investing Show. This week we're looking at our outlook for the US economy and indeed the US stock market. It's certainly going to be an interesting year. We'll look at the bullish case, the bearish case, and how some of those factors also overlap in both. Plenty to take notes out of this, but most importantly, make sure you take plenty of action. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, Mr. B. And gee whiz, we're getting around the bend because it's time for us to do our market outlooks for 2025. And we're going to kick off with the US market today, the bullish case, the bearish case, and everything in between.
Crazy outlook time already. It sort of comes around each year with the tedious regularity of an unloved season, but nonetheless, some very interesting things to talk about today.
That's right. And for our listeners out there now, it's not our job today to push an agenda or provide a view. What I really want us to explore is the bullish factors going on in the US and the bearish factors that could impact markets. Because let's face it, we don't know where the market's going to be in 6 months' time. It's impossible.
Look, indeed. And I mean, obviously, the majority of these views are going to be structured around the fact that there's a change in administration. 20th of January, we see the inauguration. And we're already seeing, as we have, the cabinet appointees that are going in there to try and drive this mandate. So I think in no particular order, and there are a couple of these actually that you could almost argue on either side is a bullish or indeed bearish case, and I'm sure we'll get into that very specifically. But
interesting.
I think what we can expect to see in the first instance is that pulling down of red tape and making it more efficient for the economy, which is definitely bullish.
Okay.
And the sorts of things that enable businesses to operate more freely without the sort of handcuffs on of certain restrictions. And one good example of that may be in housing starts, for example, which have been on the drift lower for the last few years, partly because of higher interest rates. But that sort of cutting of red tape, I think, just provides a lot more business confidence, and it's more pro-business, good for equities, good for investors.
So when you say less regulation, that gives companies more freedom to do what, AB, specifically? How does that impact us positively, I guess? Look,
I mean, if you take from an environmental perspective, which has clearly been a major mandate under the current administration, this switch to net zero and lower carbon emissions and the amount of red tape that's really come along, or call it green tape, I suppose, in the face of the ability for oil companies to explore, for example, hasn't been possible. And if that's removed, it opens the door to more carbon-heavy energy sources being tapped. And I think, in the run-up to the election, President Trump was very vocal about that they want to see that liquid gold, as he calls it, being pumped, and the US really getting back to all-time highs in terms of energy production. And why is that such an important thing? Well, it's disinflationary in the first instance. If you have higher energy costs, as we've seen globally, it's such a major component to the costs of everything, whether it's food, whereby, the farmers need more energy and it's more expensive for them to run tractors over the property. If you've got barns that require heating, it's more expensive to do that. Refrigeration, everything becomes expensive. So lower energy costs, I think particularly, will come about through less red tape in oil exploration space. And as a consequence, lower inflation and lower cost base for businesses to operate.
It's good for everyone, right? Less energy costs means cheaper flights, cheaper travel, cheaper to fill up your car, pretty much everything, cheaper freight, cheaper production and everything, right?
Exactly right. It's one of those things which effectively is a tacit tax cut in many respects. I mentioned also, as I say, about housing starts too. And they're two areas I think are important, energy and housing being two of the more expensive things that really are burdens to people in America right now.
You mentioned tax cuts. Now, that's been arguably one of the most talked about.
Great segue.
Thank you. We love tax cuts, right? One of the most talked about elements of President Trump's intended policy. I mean, less tax cuts, that would mean that there's more money left on the table for businesses at the end of the day, right?
Well, that's right. I mean, the idea of cutting corporate tax, particularly, which again was one of the things mentioned in the run into the election, means that businesses have got more money left on the table at the end to reinvest, to create more jobs, to R&D in new products and services, and so on. Which, in one level, is all positive. And I guess all of these things underpin what you'd expect to see, which is a growth in GDP, which I'm sure we'll get onto shortly. The other side of the coin is that there are a number of US tech companies that have hoarded quite substantial amounts of money offshore. If you think about, say, Dublin or in the Netherlands as an example, where companies hold a lot of royalty fees that they haven't repatriated to the US because the tax rate's been higher than they'd like. That lower tax rate may encourage those companies to bring that funding back to the US, which again frees up an enormous amount of capital to put back into the economy.
And that means they can innovate, they can employ, they can develop, and they can do cool stuff, right?
Well, they're also paying tax, which at the moment they're not.
Yeah,
so even though it might
thing.
be at a lower rate, it's on a much higher yield. And that's a hard one for people to get their head around. You think, well, it's at a lower marginal rate, but at least the tax is then being paid. The revenue is then collected to be put to work in other areas. Obviously, one of those is likely to be a more efficient government based on some of the cost-cutting agenda that's been put forward.
So with those factors in mind that we've just briefly gone through them, would you expect an increase in GDP and productivity in the US?
I think that productivity increase is huge. One of the things that I suspect that we'll start to see, and this one isn't something that's going to be a 2025 thing. I think the timeline for this is going to be quite a lot longer. And that is, if we see government departments cut back to the bone, or at least maybe not to the bone, but certainly a lot of the excess fat trimmed off it, what that does, it creates a reduced cost on the tax spending side. And where do those people go? Well, they can go back into the labour force, into the private sector, because that's where the jobs will likely be available. And the productivity increases where you're spending less on government and service type roles, and instead you're having more money generated in the private sector. So I think you see some efficiency measures coming from that as that workforce gets redeployed. That will take some time, and you can imagine with Ramaswamy and Musk getting the scissors out to some of the overblown government departments. There's going to be a lot of pushback, a lot of hostility to that. And I think one of the more interesting things I saw the other day was Musk's idea of we'll publish where we feel the most ridiculous waste of money is, so you can actually vote on it yourself. And there's an enormous cultural change that will need to happen alongside that too. But longer term, and this will take several years, if not the entire duration of this presidency, the 4 years, before you really start to see the fruits of that as they move into the private sector. But GDP growth, I think, is also very, very important, because the US is burdened with huge levels of debt, and the ratio of debt to GDP becomes problematic. If you're able to then expand significantly your GDP, which I suspect an expansionary economic policy that we're likely to see under the Trump administration happens, that ratio of debt to GDP sort of is still very, very high, but it kind of, relatively speaking, gets eased back in a little bit, which is probably an important thing too.
Just lastly, before we go on to some maybe not so favourable factors, AB, interest rates. There's been rate cuts at the back end of this year.
Yep.
We're in a situation now where this potential policy could be somewhat inflationary. We don't know. Inflation is getting down to target levels. Will they keep cutting rates? And if they do, is it a good or bad thing?
It's a very tricky tightrope to be walking on, and Jerome Powell came out quite clearly the other day and said, look, we're going to be slowing this process down a little bit, which is under the current administration, so it's not something that's slowing because of a new government. It's where the economic data points are really sitting right now. I think if you have an expansionary series of economic policies, they do run the risk of being inflationary, which may slow down potential rate cuts. That said, if those policy changes are affected through lower energy prices and an increase in productivity, for example, that is disinflationary on the other side of the coin too. So it just really comes down to the sequence that these policies really kick in and the impact that they then have on inflation. I don't think we're going to see the rate cuts as quickly, perhaps in the new year, on the basis of what the economic data already looks like. Might be a little bit slower burn, which is painful for people like me that are holding bond positions right now. But ultimately it's going to happen, I'm sure, and it's just a question of, it becomes more of a timing issue. One of the other things which we could argue either side of the coin, if we're finishing up our bullish case, is on the side of tariffs.
Yes, indeed.
So tariffs, if we consider them, could be seen as a strong positive for the US insofar as it's now looking to implement what we might call protectionism. So its companies are able to operate under an umbrella of import tariffs, making it easier for them to compete in the market space, which is a positive. There's also the alternate side to that, which is the potential for there, of course, to be some inflationary pressure that comes from tariffs too. So that one is got a foot in both camps, I think.
Interesting. All right. So let's then explore then the bearish case. So what kind of factors could we see in the US that would be bearish? One that probably springs to my mind that's more company specific rather than broad economic are these really stretched valuations that these companies have and super high earnings expectations to deliver on.
Look, it's the market's been on an absolute tear, and investor expectations are very, very high, supporting companies that are effectively at all-time highs in many cases right now, and that always is a nervous time when you're at that sort of high altitude level in the market, because you think, well, there's a lot of fresh air underneath where these companies are trading at right now. Equally, when something is in an uptrend, most likely thing it's going to continue to do, if the economic conditions are supportive, is to stay in that uptrend and continue to push forward. And if you're operating in a less regulated market where you've got lower tax rates and your profitability and earnings have got the ability to benefit from a stronger GDP figure and high levels of consumption, that's not to say that it's necessarily a bearish case either, but I agree with you. It's very, very hard when stocks are at these kind of levels to go, look, we feel this is a good time to get in. You've got to be very, very careful. It's
funny you say that. Without wishing to date this podcast, we recently saw NVIDIA's earnings. Now, NVIDIA's arguably the hottest stock in the market right now, particularly being in the AI space. Now, they had earnings expectations that were so far stratospherically high. They actually came in most areas above their expectations. But not enough where it was an outright smashing of those. They actually dropped away. Or they were down about 3% or so on their earnings day, which just gives you some perspective that, the target's way up there. They're actually above target, and still it's not quite enough.
Yeah, I think investors have become conditioned to want to see significant outperformance, bottom left.
Knockouts,
top right. And if you think about the performance of the NASDAQ 23, we saw, 53, 54% out of it. This year's not going to be that much different. And so, you're loaded up with a couple of years of muscle memory now that, oh, great, I get a significant multiple double-digit return on my money. And when that stops happening, it's going to be quite painful. And expectations are exactly that. Whether they're realistic is another matter. And if you've an American first type mandate coming out of the government where, everything is orientated toward buying American products, for example, at the expense of international markets, that has to be good for US companies on some level. That sort of patriotic purchasing, if you will, and that may pave a way for another leg up in this. But gee, it is getting pretty high, Mitch. I'm like you. I'm looking at it and I'm like, yeah, and you don't need anything too underwhelming from a results perspective to really cut the legs off from under it and see it implode.
That's right, and I think for the overall market, the forward 12-month price to earnings ratio for the S&P, I think, is somewhere in the order of about 20 to 21 times earnings. Historical sits somewhere between 16 and 17 in that range. So on that metric, it is overvalued. But then again, you could argue that is the market traditionally valued in that way anymore because of future growth prospects?
That's right. I mean, if you look at tech companies, you can argue that the case for a high PE being 23 is actually bargain basement stuff from a NASDAQ stock perspective. Double it and you're starting to get closer to where the action is. So these are stocks that value in a very, very different way, and you have to have modeling approaches that I guess reflect the fact that we are in a different era, whereby the growth potential in businesses. You look at some of the biggest companies in the world didn't exist 15 years ago.
That's right.
And they're behemoth 20 years ago, and you've got like stocks like Amazon, Netflix, Tesla, that just simply weren't around then. And here they are now as some of the monolithic platforms within the economy. So valuation techniques work very, very well with historical performance. When you look at some of these new stocks, like how do you value NVIDIA?
That's right. Yeah. Because it's priced today for what it's going to produce 2-3 years down the track.
Exactly right, which could be anything.
That's right. It's a tough one. And, you've also got the ability for inflation to creep back up, right? We spoke about this earlier on.
Yep.
If we do see inflation creep back up and then we see rates remain steady, is that going to damper people's expectations of interest rates? We talk about expectations for the consumer, right?
Well, I think, higher interest rates, or at least not necessarily higher, but stickier interest rates, I think becomes quite problematic in the property market, in that the US property market has actually been quite resilient because of we've spoken to this many times, the 30-year fixed rates that people have been on, locked in at very, very low interest rate levels. But what it's stopped people doing is moving too much, because that probability of refinance is not particularly pleasant, where you go from maybe a 2 to 3% mortgage to a 6% mortgage. So it's been a little bit static in that regard. We need to see interest rates come down in order to get that put to bed and get some movement in that market. There's an example of that also from an inflationary perspective, and I think it's very important to be minded of this. Potentially you have a significant increase in workforce if you've got people moving from the public to the private sector, which then takes a lot of the heat out of wage pressure, which is a disinflationary issue in the first instance. So you've got more supply coming in to the job market. And on the back of that, also the overarching impact of potentially lower energy prices. Energy prices are global, so it's going to be a very hard job for the US to be able to assuage global oil prices and energy prices across the board, but they do have the ability to do that by becoming a significantly bigger exporter of energy, which is what the intention certainly is there.
Anything to do with tariffs or immigration, AB, out of the Trump policy that might be bearish for the market next year?
Look, tariffs, we've argued that they can be positive, they can also be negative. So if your input costs are increasing for, say, let's just say urea, which is a major fertilizer that comes out of the energy complex as a byproduct of refining. If you have tariffs on that coming out of, and we saw this with AdBlue, remember the big AdBlue crisis?
The shortage, that's right.
It's bonkers. We bought a bit of that up because we've got diesel vehicles on the farm and stuff. Yeah, that's been and gone. But that, if you can imagine everything suddenly becoming double the price as an import, then that fertilizer cost is also, the ammonia cost, for example, for fertilizer doubles, which is really problematic for food stuff. So I think you're going to see some very selective implementation of tariffs, but they do have the potential to become inflationary, that's for sure. The other side of the coin, as you mentioned, with immigration, it's a hot button in the US right now, and I guess there are two types of immigration. There's legal immigration, and then there's illegal. And again, the incoming government, the Trump government, has made it very, very clear that they intend to sweep out a significant number of illegals, as many as they can. Does that create a skills shortage in the marketplace, and does it add to labour costs? That's to be seen, because how many people that have come in as illegals are actually working in the labour market right now? And if they are, it's typically at the lower end of that market, which to an extent has pulled wage costs down a little bit for lower income earners. If you have come to America because the economy is booming and we want you to come in on a skills visa, or in the traditional sense that the country was built on, and personal anecdote, I know you've been to New York too, when you go across to Ellis Island, the Statue of Liberty, and see what particularly the Europeans and especially the Italians went through as they came in, the difficulty, the challenges of coming into America as new immigrants and as families and being away from everything. That country was built on immigrants, as Australia has been too. But it was also built on immigrants that were coming for a better life and to contribute to a society to build a better future for their family. And I think if you see a return to that type of mandate where, look, we welcome immigration, provided you're prepared to work and provided you're coming here to contribute to what America is all about, and also what your future looks like in the land of opportunity, which I know it to be, having spent plenty of time there with business there and so on. I think it'll be very, very interesting to see what that shade on immigration looks like. So there's two sides to it: getting the illegal aliens out, and then increasing a migration flow into a growing economy of people that really want to contribute to it. And heck, there's a lot of people who would love to move to America in the legitimate way.
Too right. Anything else bearish before we wrap up here today, AB? I mean, I think we've covered broad market, we've covered company specific, policy and political. Is there anything else that springs to mind for you?
I think world conflict, unfortunately, is not necessarily good or bad for business. So if you think we've got two major conflicts going on in the Middle East and obviously in the Ukraine at the moment, and the US is front and center as a weapons manufacturer for exporting its particular product to those areas of the world to support the conflicts that are going there. If we see an end to the conflict in both of those areas, which again is something that was touted, we'll get it closed down and finished, that will have a negative impact, initially at least, I think, on the armaments and weaponry technology type businesses. That said, I think a stronger America, which is also what seems to be the mandate, may see the US military retooling a little bit too. You take the AUKUS submarine stuff that we're in bed with America on right now. America currently have 17 attack submarines. They want 66 to have a fully operating fleet. So they're a mile away from getting to that level. And obviously Australia's even further away because we're only getting any cast-offs once they've fulfilled their obligations. Under the Biden administration, we've seen those submarine output cut to 1 a year. It was, I think, 2.6 a year prior to that. So if we see less money going toward those conflicts around the world and more going back into the defense of the US and achieving its objectives, that will be a yin and yang, probably in a positive way too, because you've got 2 less conflicts in the world and a stronger military US, which is probably not a bad thing for global stability. So initially a bit of a negative there, but if that well, call it a war machine is redeployed internally to building up America's military might to what it probably needs to be in the New World Order, then I think that's probably a good thing rather than negative.
Well, there you have it. There's the bulls and there's the bearish. Now, I'll remind everyone here too, if I can just sort of throw in my smart statistic for today. According to Citigroup, the S&P 500 on average adds on about 11% 1 year post an election. So the odds are in your favor out there. Don't bury your head in the sand, go and get stuck in.
Too right. Interesting enough, for gold, it's the opposite too, right? First year of a new government, gold typically struggles a bit. Not
strongly negative, just a little slightly negative, mostly flat, and then bonds are much the same. They're about flat.
There you go.
On average.
Great stats, numbers don't lie. So let's see what we can eke out of this opportunity for the year ahead. Certainly going to be an interesting year, and
I know.
I think it's not just economically either. I mean, it's an enormous cultural shift that we're going to see there too, and I've mentioned it multiple times through the last year in the run-up to the election. We hope, we pray, we don't wish to see civil unrest as we see a transition of government. I suspect that may well be something we do see. So some short-term volatility in markets may also be something that we see in the early part of 25 as that transition of power happens. And then from there, let's see if our outlook comes good. There's certainly some good and bad in everything. Let's hope it falls on the good side of the ledger. It's great for our clients to continue making money, but also good to see a strong America that's regained its, I guess, vision as to where it wants to go.
That's right. Absolutely. Thank you very much for today, AB.
My pleasure, anytime. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.